When a merchandising business sells their inventory, they have to record sales transactions. So when revenue is earned, we've already learned that we record that with a debit to cash if cash is received and a credit to revenue. So with a merchandising business, the specific revenue account that we use is called sales. So for example, assume that on March 3rd, Net Solutions sells merchandise for $1,800. That's the sales price. These cash sales are recorded as a debit to cash and a credit to sales. So you can see the journal entry here. So we talked previously about the difference between the perpetual inventory system and the periodic inventory system. So with GAAP, we have to use the perpetual inventory system. So in addition to recording the cash received and the revenue generated by making a sale, we also, with the perpetual inventory system, have to show the decrease in the inventory account as well as the cost of the merchandise sold. So there's really a two-part journal entry. You just saw the first part where we recorded cash and sales. So then we also have to record the expense that we incurred with the inventory, which is called cost of merchandise sold, and then the reduction in the amount of inventory on hand. And that's why we have to credit the inventory account. And this is because of the matching principle. So remember, we want to match expenses in the period in which we generated the revenue. So if you think about it, when a merchandising business purchases inventory, even though they might be paying cash for it, they don't record an expense at that time. So they would record a debit to inventory and a credit to cash. So there's no expense recorded for that inventory until it's actually sold. And that's why that account is called cost of merchandise sold. So that represents the expense that was incurred in order to get the inventory that is then sold to generate revenue. So here's a full example of the two-part journal entry. So Net Solutions sold merchandise on account for $18,000. So that was the sales price. The cost of the merchandise sold was $10,800. So this is going to be the cost of merchandise sold that we record. So in the first part of the journal entry, you record the sale. So in this instance, cash was not received. It was sold on account. So accounts receivable was debited, sales was credited to show the revenue earned. Then in the second part, you have to record the cost of merchandise sold. So that's an expense, which is debited. And as you can see, this number correlates to the cost of the merchandise. And then also credit inventory to reduce the amount of inventory in the account, because now you're selling some inventory, so you have to adjust that on the books to reflect the reduced amount of inventory that you now have on hand. So be sure that you note, when you do the first part of the journal entry to record the sale, you use the sales price. In the second journal entry where you're recording the cost of merchandise sold, you use the cost. So here's an example that we can work. TOL's Closet has sales of $15,700 on August 7th and received $9,900 in cash. So sales of $15,700, received $9,900 in cash. So that means the rest of it was recorded as accounts receivable. So if there was $15,700 in sales minus $9,900 that was received in cash, that leaves an additional $5,800 that was recorded as accounts receivable. Okay, so the remaining customers put the sales on account. That's what we just figured. The company paid $7,750 for the merchandise. So that's going to be the cost of merchandise sold. Prepare the journal entries required to record the sales using a perpetual inventory system. So now we record the two-part journal entry. So the first part of the journal entry is to record the sale. The sale happened on August 7th. So the company received both cash and some sales on account, so accounts receivable. So here we'll have actually two debit accounts in this journal entry. So we'll record cash received of $9,900, accounts receivable of $5,800, and together those total the full sales amount, which was $15,700. So that's the first part, recording the cash, recording the sale, the revenue. So then the second part of the journal entry is to record the expense, which is cost of merchandise sold, and to adjust the inventory account. So when you record any type of expense, it's a debit. So you debit cost of merchandise sold and credit inventory. And so the cost of merchandise sold is $7,750. So if you'll remember when we talked about the other side of things, which was the purchasing side, when the business purchases the inventory, we talked about purchase discounts. So now on the flip side, if the company is the one selling the goods, then from the seller's perspective, it's called a customer discount. But we're talking about the same thing. It's just looking at it from two different sides. If you are the seller, it's called a sales discount. If you are the buyer, it's called a purchase discount. But it's the same thing that we've already talked about, 210 net 30. So here's an example using a discount. Modern Glassware sold $8,250 of merchandise to Kitchen Supply on account on October 10th with terms 210 net 40. So that would be a 2% discount. The company paid $2,100 for the merchandise, so that's cost of merchandise sold. Kitchen Supply paid for the purchase on October 17th to take advantage of the discount. Record the sale of the merchandise and the receipt of the payment. So the sale of the merchandise is going to be a two-part entry, and then receipt of the payment is going to be separate because that happened later on October 17th. So first of all, let's calculate what the actual sales price ended up being. So it was $8,250 worth of merchandise, but the customer paid the business within the period to receive the discount, and it was a 2% discount. The 2% discount came out to be $165. So the total price minus the discount gives a sales price of $8,085. So that was the total sales amount that's recorded. So the first part of the journal entry on October 10th is to record the sale itself. So this was sold on account. So instead of debiting cash, because cash wasn't received, you debit accounts receivable. And we're recording the revenue, so we credit sales. And we use the sales amount, which is $8,085. The second part of that journal entry is to record the cost of merchandise sold and adjust inventory. So you debit cost of merchandise sold, credit inventory, and here you use the cost of the merchandise when the business purchased it as inventory. So that records the two-part journal entry when the sale was made. So then the second thing that the problem asks to do is record the receipt of the payment on October 17th. So October 17th rolls around and the customer pays the invoice. So therefore, this business is receiving the cash that was previously recorded as an account receivable. So cash is received, so debit cash, and credit accounts receivable. And the total sales price was $8,085. So we talked about purchase returns and purchase allowances when we were talking about purchasing inventory. Now when we're the ones selling it, they're called customer returns and allowances because we are granting those to the customers. So it's the same exact thing, you're just looking at it from two different sides. So if you are the seller and you have customers, they're called customer returns, and that's when the customer returns the item. It goes back into inventory. That's a return. An allowance is when the customer does not actually return it, but instead gets a price reduction. If there's the wrong quantity is sent or if they're damaged and the customer asks for a lower price essentially because something is damaged or missing. So an allowance is a price reduction.